All right, now, as part of the conversations that I have on this program, I try to bring you voices of people that manage your money. And to that end, I'm speaking to Satish Ramanathan today. Satish, thanks so much for taking the time. We spoke a while back, and I'm glad that you've taken the time to speak to me today. I was thinking of this Frank Sinatra song, That's Life. And the words go, you're riding high in April, you're shut down in May. And essentially, the song talks about how eventually life sometimes gets you down, but then you pick up eventually. It's been a bit of a tough year, hasn't it?
It has been indeed, Alex. And thank you so much for having me here and explain what could have gone better for the economy and for the markets. But broadly speaking, yes, it's been a challenging year, and some of the stocks have consolidated or not given any money from the mid of 2024, some from even end 2023. So it's been a long process of consolidation and grind which has taken place, and I think that's something which has unnerved many investors.
It has indeed. Now, when we spoke last, yours, and I'm talking about the Flexi Cap fund now, it was actually doing particularly well. And this is perhaps because, and correct me if I'm wrong, your portfolio was actually pretty true to label in that you were truly Flexi Cap. You had a sizable allocation to the broader markets as well. And that is what has resulted in this relative underperformance over the last few months. Would you agree?
Yes, I mean, we continue to believe that there is a good growth of potential and opportunity in the mid and small cap space. It may be that the markets have corrected due to certain technical or liquidity issues, but there's nothing wrong with the companies per se in either category, whether it be mid cap or small cap. Companies continue to generate free cash flow, continue to grow. One may debate about their valuations, however, and that's something which may have probably resulted in this mild underperformance.
Let me ask you about those valuations, because as we stand after the second quarter, earnings have actually been to a large extent in several pockets better than expected, though at a consolidated level there are still reasons for us to not yet pull out the party hats, right? So therefore, as you look forward to the second half, are you seeing reasons for us to move out of this funk? Or do you think that that overarching concern about the rupee having dropped to now all-time lows, the fact that foreign institutions still don't seem to be seeing value in the Indian equity markets, all of those things persist and will likely remain the case heading into 2026 as well?
Maybe these reasons play out for the first quarter of 2026 as well. But broadly speaking, I think we are coming out of it. We are seeing private capex revive. We are seeing growth come back in consumption. We are seeing a government that's actually willing to pull out all stops to make it happen. Maybe infrastructure and capital goods takes a little bit of a backseat in order to push the consumption story along. We've had three major triggers coming along. First two have already happened, and the third one likely to happen in the next 6 months or so. First was the income tax cut. The second was the GST cut, and the third would be the 8-pay commission. So all put together, we would see a situation where the consumption basket gets stimulated adequately for growth.
Okay, Satish, let me ask you specifically about the rupee, because it's breached that 90 per dollar mark. And I was looking at the dollar returns at this point. We're talking about year to date for the Nifty 54%, which is not really very much. It's actually a bleaker picture for the broader markets at this point. So the question that I have to ask you is, in the note that you put out at the end of November, start of this month, was that you said that the rupee depreciating sharply from this point is a key risk. How much worse can it get?
I think the basic issue that we need to bear in mind is that we still have a current account deficit. Our trade is currently a little impacted by the US tariff issue. We haven't as yet successfully got a treaty in place, and that's perhaps spooking both currency markets and the equity markets simultaneously. So we need to see some revival of trade, our current account deficit gap narrowing, and probably a trade treaty on the table sooner rather than later.
Okay. So, with that context in mind, help me understand how you see valuations right now and relative value as you look at your portfolio. Do you see reason to double down in certain pockets? Do you see reason to churn a little bit where you've had a little patience and it's not paid off?
Oh, tell me about that. But the basic issue is that what we see is that there is growth reviving in certain pockets of consumption. There's also some growth revival in financials, and you can see growth coming back in pockets sporadically, but at an aggregate level as well. That's one. And the consumption, Philip, which was a large portion of the economy, is something substantial which will have a multiplier impact across the board over time. So we are a little more positive and optimistic than what the markets would suggest right now. Coming to valuations, as valuations is always a relative game. India was expensive relative to other countries and has become less so because of the underperformance. And perhaps with this sharp correction behind us, we would look poised for a nice allocation over the next year.
Uh, I often ask about return expectations and how to benchmark them, right, Satish? Because this is ultimately for my viewers and potentially your unit holders, they will understand how they should benchmark their own expectations. So, as you look forward, now that we're drawing close to the end of 2025, it's been a year of consolidation. We've spoken about that. As you look forward, what are the signs that you're reading that will tell you that this will be significantly better, and how much better? I'm not asking you to necessarily predict what the returns could be, but I'm asking you what your thesis is heading into 2026.
So I think what's happened right now, Alex, is that we've seen a situation where inflation has fallen considerably, and we are seeing wages increase. So the consumable consumption basket is well poised to recover. We have seen GST cuts trickle through, so earnings growth should hold up. And if it holds up into the double digits, I think that's about what we would earn into the next year as returns as well.
I wanted to ask you that because I'm wondering about nominal GDP, and we're speaking at a time when real GDP is flying high, right? It's significantly higher than a lot of people had anticipated, but at the same time, you had inflation in October that was at 0.25%. And so therefore, as a result of which, your nominal GDP, which puts your real and inflation together, and I'm explaining this for my viewers who don't necessarily pay as much attention to the economy as a lot of other people do, it's not very high. It's in single digits and could remain that way for a little while. And that is tied to your earnings as well, your corporate earnings. Are you concerned at all that corporate earnings will get impacted by this?
I think so. And you do see a situation of corporate earnings having troughed and recovered a little bit in the second quarter. And we need to understand that corporate earnings are impacted by a lot of pulls and pressures, including currency, interest rates, and things of that sort. It's not just the top line that counts, it's also the cost of inputs, etc. So, to presume that earnings growth will track the GDP growth, nominal GDP growth, at a mature economy makes sense, but we have certain drivers in place. For instance, there's also the bracket creep, where unorganized becomes organized, and therefore you tend to outperform the nominal GDP growth. And we see several other reasons why one has to be a little more optimistic than what the nominal GDP would suggest.
Okay. Uh, at this point, what, in your opinion, is going to be the next key trigger? Would it be the tariff deal or a trade deal between the US and India, or would it be something else? And what, according to you, is the key risk heading into next year? Some people have talked about the yen carry trade unwinding as something of a risk for global risk assets, not just India. How do you see it?
I think the tariff trade treaty that we need to conclude with America is very important because it impacts a lot of high employment sectors like textiles, gems and jewelry, etc. So we need to close that aspect pretty fast. If not, it could have lingering damages to consumption, to the banking sector, and several other dominoes that could fall. So we need to be very conscious about that aspect, one. The second aspect is on the global side is that if US continues to grow and attract foreign capital, there would be a shortage of dollars in the global economy, which will then kind of permeate into liquidity squeezes across many emerging markets. That's something which we need to be wary of, and how the central bank would infuse domestic liquidity, even as the forex reserves drop a little bit, is something which remains an enigma. And that could have a slowing impact on the economy if it's not handled properly.
Understood. Satish, as always, a pleasure speaking with you. Thanks so much for the insight that you've provided, and wish you all the best for the new year.
Thank you very much, Alex, and thanks for having me on board.
My pleasure. All right, that brings us to the end of this edition of Your Money Matters. Thanks so much for tuning in. Do stay tuned. This is NDTV Profit.